Hello and welcome to the Fintech Show. Now in today's episode, we're going to be finding out what it's like to sell your fintech organization during the time of the great fintech reevaluation. As the industry suddenly goes from highs to lows to finding out really how much your company is worth, it's never been a stranger time to sell. But that doesn't mean it's a bad time. The fintech industry has taken a bit of a kicking, but for a lot of exit strategies, it often leads to companies being in a better place. So we wanted to find out how to create the perfect exit strategy if you decide to sell your fintech organization. So we sent Hannah Duncan to Cazenove Capital to speak with Freddie Lower to find out the perfect exit strategy for your fintech sale. I also spoke with Mark Bradbury, who'd previously sold fintech organization Applied Financial a couple of years ago, just before the pandemic. We really wanted to get the perspective and the emotional input that CEOs and founders have to go through when selling their fintech organization.
So I'm Freddie Lower, I'm a portfolio director at Cazenove Capital, and Cazenove is the high net worth and ultra high net worth wealth management business of Schroders. And my team look after almost exclusively business owners and entrepreneurs, and we're looking to manage investments on a discretionary basis primarily. And my role within that is the day-to-day relationship management, but also providing the high quality investment advice to the end clients around where they should invest their money.
Okay, so you sound like a real expert. Can you explain for us what has been going on in the market recently?
Sure. So it all started really back at the beginning of 2022, where inflation started to get out of hand, and as a consequence, central banks started to raise interest rates to try and cool down the economy and bring down inflation. Now, a consequence of that for fintechs and smaller startup businesses that perhaps aren't profitable now is their entire valuation is predicated on the present value of future profits and future earnings.
Right.
So in an environment where interest rates have gone up, a future pound of profit is worth less today when interest rates are higher, because you can get more money risk-free on cash in the bank, and therefore those future profits are worth less.
Is it because the fintechs are borrowing money as well?
It's more to do with how you calculate their valuation. So when you work out what a company is worth, you look at their earnings and their future profits, and then you apply a discount factor to what that's worth today. And it's that discount factor is what's changed with interest rates. And really, one of my colleagues summed it up by saying that when the Fed, so the Federal Reserve, the US central banks, slams on the brakes, then someone goes through the windshield. And that's slightly what we've seen, particularly within the sort of startup businesses and less profitable companies, what we call growth businesses. But more recently, also within some larger banks, Silicon Valley Bank, and more recently Credit Suisse. Both these organizations were invested in assets that were very long-term in nature, and the value of some of those assets changed quite dramatically. And ultimately, Credit Suisse was really a sort of old-fashioned bank-run scenario. If you remember Mary Poppins, when the boy shouts that the bank's not giving him back his money and causes the whole bank to collapse, that's really what we saw with Credit Suisse. And
On Twitter?
Indeed, yeah, absolutely. And Silicon Valley Bank, it was really the pace of withdrawals was what was so astonishing there. So on the Thursday before it collapsed, they had something like $42 billion of deposits flow out of the bank in one day, so over the course of 10 hours, which is the equivalent of $1 million per second, every second for 10 hours straight. Now, if you contrast that with 2008, the last sort of major bank run in the US, Washington Mutual had $16.8 billion flow out over a period of about 10 days. So a third of as much money over a tenth of the amount of time compared to Silicon Valley banks. It's really just the pace of the withdrawals was what was so detrimental there, and their balance sheet and how they'd managed that.
So what does this mean for the average fintech now? What are they going to do? What are their options?
Well, if you're looking for an exit, then really the three routes to exit are IPO, selling to private equity who want to buy a majority stake in your company, or selling to trade or a strategic buyer, either another listed company or potentially a larger business that's got some PE funding in it. Now, of those three options at the moment in the current market, IPOs are basically completely off the table because it's a terrible market to try and take a company public into. Therefore, your exit strategies are really down to private equity, buyout, or selling to a strategic buyer. And there's sort of two kind of routes here, in that some fintechs will be profitable or close to profitability, will have cash on their balance sheet, and will be pretty high quality businesses. Now, those will be pretty attractive to private equity because there's been a lot of money raised by private equity over the last few years. They've got lots of dry powder that they want to deploy, and they're looking for a good home for some of that capital. So it creates a sort of survival of the fittest type of scenario whereby the good companies will still be well bid. Of the less good companies, the ones that perhaps aren't profitable and are going to need to raise another round before they exit, there I think it's a bit more challenging because those companies are going to potentially raise quite highly structured rounds because it's a difficult environment to raise money. Therefore, any potential investors are going to demand preference shares that mean that they get paid out before other investors. And ultimately, these companies may struggle to raise a round, in which case they'll be looking either to try and do what they can to bring forward profitability, conserve their cash, extend their runway, or potentially they'll run out of cash and they'll be looking for an exit opportunity, although it will probably be a less favourable exit than they might have hoped for if their business is simply running out of cash.
As I say, more recently I sold Apply Financial in March 2020, 2 days before the official lockdown. So that was a bit of a tight squeeze in, but we got there in the end.
Absolutely incredible. I mean, talk about good timing, and people often talk about timing the market, but actually as long as the product is good, as long as the company's good, I'm sure the exit strategy is just as good. Now, could I actually inquire about that? How do you think that market reevaluation would have changed exit strategies as a whole, but also your exit strategy, having sold just a couple of days before it?
Yeah, well, the thing about making an exit, so it's a bit like the tip of the iceberg, and you plan a 9-month exit. So the most sensible thing is to bring in some good corporate finance people. I call them spreadsheet jockeys, but they're brilliant with spreadsheets, which is always good because that's part of the negotiation process. But that's 9 months before, and then you create an information memorandum, and then you go out to the market, and that doesn't change. Even in today's marketplace, it's going to take 9 months to sell. The difference is that I think in a lot of cases now people are looking to sell because it's difficult to raise funds for growth, for instance.
Yeah.
Whereas when I sold Apply, raising funds for growth through VCs or private equity or whatever, private family money, wasn't that tough. My decision to sell was based on the fact that, I had a good ride for 9 years, and I wanted to basically retire.
Yeah.
Right? So the difference here now today is that the prices for companies are not so buoyant because of the lack of funding that's around, not just for growth, but funding for acquisition as well. So people have tightened their belts. They're sitting on their hands. So it's a different time now than it was in 2020 when I sold pre-COVID.
Yeah. Now, with that in mind, what would your advice be to entrepreneurs looking for exit strategies? Is there places for resources that they can go, organizations that can take them through it? What would your advice be?
Well, I mean, there's quite a long answer to that because it's in different parts. So the first thing is, when you have a company that you want to sell, if you don't know who the potential buyer is, then you haven't shaped the company to be attractive to that buyer, right? Yeah. So that's number one. So when I sold my company, I knew who the buyer would be. I knew when I set it up who the buyer would be, because if you build a product that they find attractive, or you compete with them and then you start taking their customers, they're going to come and buy you. So that's number one. Number two is that get a really good corporate finance team in to do it. Don't try and do it on your own. You need experts, people who can handle the process. It's a bit like if you're building a house, you get an architect in, you get a project manager, You know, if you try and do all that yourself, well, you'll fail. And even with a corporate finance team there with you and a legal team, you still find that you're literally, for the 9-month period that you're doing this from start to finish, literally every day is taken up with work to get you over the line. So it's about, you know, once you make your mind up, there's literally no turning back.
And how that is fascinating about how important the mind is when it comes to this, because there's so much going through one's head when selling effectively something that could, for some people, be that almost like their baby. You know, so I'm going to ask a personal question here, but what was going through your mind when you were looking to sell Apply Financial?
I think the first thing is that, am I making the right decision? Because we were doing really well, it was growing. You know, we literally pretty much created a marketplace for the validation tool that nobody thought they needed. A bit like mobile phones, right? We never thought we needed mobile phones, so we got them. Now we can't live without them.
Yeah.
And once we'd created the Validate tool and hundreds of institutions started using it, they couldn't live without it. I even get them phoning me up now, actually, saying, "Oh, you know, what are you doing? You know, are you going to do it again?" Yeah. Because we just so loved the tool. So I think the decision to sell was based more on, you know, we've been going for 9 years, we're growing really well, and somebody always said to me, always get out when you're at the top. And perhaps there's an element of, you know, you start to get a bit bored with it because, well, you've been doing it for 9 years. So I made the decision in July of 2019, not 1919. I'm not that old. 2019 to sell. Yeah. And then got the corporate finance people in and went through what I was trying to do and did a bit of a beauty contest, looked at 3 different corporate finance companies, and then the one I chose was proven to be you know, a masterstroke decision because they did such a fantastic job of helping me to sell the company.
Our audience are basically all fintech. Some of them might be going through this right now. They might be thinking, oh God, I have to exit right now. What would be your message to them?
I'd say if you are thinking about an exit, be clear in your mind about why you want to exit. In the current environment, you know, there are 2 types of fintech. Ones that have got plenty of cash on their balance sheet, are in good place, are profitable or close to being profitable, and they're in a really strong position to either, you know, make smaller acquisitions or carry on the journey. The smaller ones that perhaps aren't profitable are probably going to need to raise another funding round before any meaningful exits, and you know, that's a challenge in this environment, I think, to get through another fundraising round. So if you do manage to achieve that, you know, well done. It's a very, very tall order in this environment. But if you aren't going to raise that funding round, or you don't think you can, you know, there's the risk that, you know, your cash burn becomes too much to deal with, or that you end up raising a highly structured round with lots of preference shares and increase the preference stack. And so, you know, ultimately, failing to raise a round may lead to an exit, although it's perhaps not the kind of exit you might have wanted, not necessarily a great outcome. But I think, you know, focusing on profitability, focusing on making the business sustainable and durable for a difficult environment is going to help either when it comes to raising a round, or if you're looking to sustain the business through this more difficult period, then that will hopefully get you there. Ultimately, we're a wealth management business, so our job is managing investments for wealthy individuals. And in the case of founders and management teams, really what we're trying to do is build relationships with those people 18 months, 2 years before the actual liquidity events through our own origination research and our external relationships and our partnership with Lloyds Corporate Bank, who look after 1 in 5 businesses in the whole of the UK. We're getting in front of some of these businesses in plenty of time before an exit. Now, we haven't actually got any services to offer or any products to provide until there is that pot of money to manage. But what we try to do is earn people's trust and build that relationship on the strength of really good introductions to corporate finance advisors, legal advisors, new accountants, and really help assemble that team around the founder and management team so that they're getting the best possible advice. And particularly in a sector like fintech, where it's a regulated industry, that's quite a challenging environment to undertake transactions in. And there, probably is more so than many other industries where there's that high regulation, it's really important to have the right advice. And we're very discreet as a business, so we can't really talk about actual client situations. But what we can talk to is our sort of business's broader involvement in fintech. So as I mentioned, we're part of the Schroder Group, and Schroders is active across all parts of financial markets, but the bit that's most relative to fintech is our private capital business, Schroders Capital, which is one of the leading private equity and private asset managers. And there they have had exposure to Revolut right through from its sort of early fundraising rounds, initially through the other underlying GP relationships they have, but more recently they invested in the Series E fundraising. And that's quite a good example of our private equity business kind of growing and investing with those businesses. The other quite interesting one is Tession, which is a sort of cybersecurity, email security software. And Schroders was actually their first enterprise clients, and really helped them with sort of developing a product, steering it in a direction that worked for us. Schroders Capital then invested in that business, and it's now an incredibly successful company and is used across the whole of Schroders globally and a number of other enterprise clients.
Thank you so much, Mark and Freddie, for appearing on the show. It's been such a pleasure having you on. And also, I want to say a massive thank you to you, our viewers. You can catch the rest of the series and so much more over at ffnews.com, of course YouTube, but especially LinkedIn, where you'll see Mark, Freddie and I in the comments. Thank you very much and goodbye.